very likely we may see over the next week or so this market try to work its way back down towards 5,900-ish, maybe 5,850, which would give you a really good entry point to add your equity exposure, because that should work off a good chunk of this short-term overbought condition.
Welcome to Thoughtful Money. I'm Thoughtful Money founder and host, Adam Taggart, welcoming you back here at the end of another week for another weekly market recap featuring my good friend, the peacemaking pacifist portfolio manager, Lance Roberts. Lance, how you doing?
I don't know why you would call me a pacifist after our conversation last week. You know I like to fight.
So I feel a little bad because we had this war theme running all the way through last week's discussion. And then obviously, the big news this morning, Lance, is that Israel issued a pretty major preemptive strike last night against Iran. So I wanted to focus more on peacemaking from here, and hopefully world events will follow this week.
You know what? To be completely fine. I'm completely good with that.
All right. And also, folks, we're recording this a bit earlier than normal on Friday morning because I'm doing a special report live stream with Ryan Bohl, who is RAIN, which is one of the largest sort of geopolitical strategy corporations in the world. He's their Middle East specialist. So if you're watching this on Saturday when this video airs, that live stream should have already happened. You can watch the recording of that if you want to get into the real details of what's going on over there, what is most likely to happen next, and hopefully what we can all hope for as swift a resolution as possible to what's going on there. All right. So, and we'll probably be a little bit shorter today as a result for that, folks. So just FYI. All right. No, so in our previous conversations, Lance, when Israel and Iran have gone at it, my recollection is that you've said, it's generally not something that the markets get that worried about. We are seeing stocks lower here today, right as the market starts opening. But is this severe enough to, you think generate some sort of material market impact that we should be aware of? Or do you think until, some line of escalation is crossed, it's really not going to be that much of an issue markets wise?
Well, and again, it's always when something initially happens. So let's step back one second here. The thing that always gets the markets is the one thing they don't expect, right? We've talked about this before. The market has been doing fantastic over the last, really since April the 9th. We've had this 20% rally in the markets. We're back, we're up like 3% for the year for the S&P 500. And, all those previous concerns over debts, deficits, whatever, those are pretty much inflation. That's all kind of faded into the background, and everybody's focusing now on earnings. Markets got very extended, very overbought. Last week we said, hey, look, we're going to have some type of correction in the markets. What triggers it? Who knows? It's always some unexpected event like this. Now, this morning, markets opened down, but they're already recovering. The futures were down a lot right after the event occurred. And then before the market even opened, the S&P was down like 80 basis points. As we're talking, the market's just opened. It's 8:44 Texas time right now. So the market's just opened 15 minutes ago, and the index is down about 68 basis points. So, very quickly, this market's already kind of looking through the event going, this is probably going to be pretty self-contained. It's probably not going to escalate to a great deal. Now, the markets could be wrong, mind you, and we'll see what happens. Because we haven't got a response back from Iran yet, and they just took out one of their leading, one of their highest ranking leaders. They've obviously destroyed their nuclear facility, so that's there's going to probably be a tit for tat event coming out of this, as we've seen before. Before, when they've responded, that was the end of it. It was just, okay, we hit you back, we're done, we're even, we're good. Whether that's the case this time, who knows? But again, really early on, the markets are looking through this, but longer term, and I think this is the juxt of your question, is that, and here, let me just share a chart. This is a long-term chart of the S&P going back, through history. And look, there are certainly events in time that have caused, more severe corrections in the market, like the Arab oil embargo led to, the 1973-74 bear market. We had inflation, other stuff going on. Back-to-back recessions that all impeded on a bubble that existed at that time of the Nifty 50. The dot-com crash, 9/11, of course, financial crisis, and these events have always occurred. Markets eventually recover. But what's important to note is that the majority of the time, unless markets are extremely in like bubble territory, like we had in the dot-com crisis or in the financial crisis, you need some type of underlying financial disstructure, so to speak, in terms of there's an underlying fundamental issue, not valuations. Valuations aren't the issue. Valuations are a reflection of the issue. But you have to have some type of underlying financial problem. So in the dot-com crisis, we had just thousands of companies with actually no earnings that, when Enron blew up, it kind of brought all that stuff to light. The financial crisis was subprime. So we don't have that type of underlying financial problem at the moment. So again, this will probably be something to, even if it scales up, will probably be fairly short-lived unless it begins to really impact oil prices. And, we wind up at $130, $150 a barrel oil or more, and that really begins to impact the economy. We start looking at a recession. That's where the markets are going to have to reevaluate what forward earnings are going to look like. And then that's where it may escalate a bit. But
Okay.
unless that happens, this should be fairly short-lived.
Okay. And let's hope it is.
Yeah.
Speaking of oil prices are up fairly substantially on this news. I think this morning they're up 7%, but they, pretty quickly have gone from the mid 60s now to the mid 70s, and where they go from here, who knows? And obviously that'll probably heavily depend on how things unfold here in real time. But Lance, you don't think it's going to become sort of a real market economy impacting issue until and unless it gets up above 100, maybe to the $130 a barrel range? Is that what you're saying?
No. You don't know where that impact is going to be. It's going to be when it feeds through into the consumer, right? And so right now, the big concern has been tariffs recently. It's like, oh my gosh, we have tariffs. That's going to cause a recession because of the big jump in inflation. Well, tariffs didn't show up in the latest inflation data. It will show up through oil prices because oil prices feed through to everything. So
Everything. Yeah.
where if this jump in oil prices sticks and stays at 70, 80, $90 a barrel, that's going to start to feed through. So we'll see an uptick in inflation. We'll see an impact on the consumer if the consumer starts contracting because of that uptick. And we're already seeing defaults rise on credit card debt. Buy now, pay later is getting under stress. We're seeing, delinquencies on student loan debt, all those type of things. So we already know the consumer is slowing down. We've seen that in the economic data. The employment data is slowing down, suggesting that that's going to start to weigh on the consumer. And now you hit them with an impact of higher oil prices. That could be the actual real catalyst that gets this economy to slow down much quicker than what people are expecting if it sticks. Now, again,
Right.
if this is a near-term event, we see a spike in oil prices. Oil is very overbought right now. So if this fades pretty quickly, oil prices are going to come back down and that pressure will get relieved.
Yeah. Let me just ask this. You understand oil better than I do. My recollection is that kind of like $70 a barrel is sort of the long-term average. So if we hang out here at 75, I don't get a sense you think it's going to be that notable from inflation. It's going to be for inflation. It's going to be more if it gets into 80, 90 plus, correct?
Yeah, I mean, here's a chart of oil price. This is crude oil, West Texas Intermediate. This is where we are right now. We're about $73 a barrel. We were just at, near 80 back at the beginning of this year. We were pushing up towards 90, last year. So again, none of that led to a massive surge in inflation. It didn't, we did see these rallies in oil prices did show up in inflation. We had this big spike in oil prices back at the beginning of this year. We saw, CPI uptick. Everybody's like, oh, I see inflation's coming back. Well, that was just the feed through from higher oil prices. So this jump that we're seeing in oil prices, we just had 4 prints in a row of CPI that were below expectations. So what that means is that very likely the next print we're going to get is going to be above expectations. And that is two reasons for that. One, when analysts are wrong 4 times in a row, they start cutting their expectations. which leaves you open for a beat to come in. And so with this jump in oil prices, I would expect inflation either next reading or the reading after that, if it sticks, to be higher than expected. So we'll start to have all these inflation narratives again, but that's just going to be a function of the feed through of these oil prices.
Okay. Um, I just wanted to make sure people weren't, starting to freak out over $75 oil.
No, it's
Yeah.
$75. Actually, if you're long oil stocks, this is actually a really good level for oil stocks. When you're down into the 60 range, it's becoming non-profitable to drill. And if
Right. They're not making money. Yeah.
right, and if you take a look at rig counts, those have been dropping pretty sharply because of this decline in oil prices. So this actually is beneficial for a couple of things. One, if we can get back up in the mid 70s and hold it, that's actually back into a fairly profitable range where energy companies will hire people, they'll start to pop wells, they'll put people to work. Energy jobs are some of the highest wage paying jobs in the country. So, this is actually good economically. This is a good level to be at. The rapidity of the move, how fast this move is, that's the thing that hurts people, right? Just initially. If the move is real gradual, the economy just adapts to it. It's fine. But when you have these very sharp moves, all of a sudden last week here in Texas, as an example, last week I filled up with gas. It was $3.02 a gallon. If I go to the pump next week and it's $4 a gallon, I'm going to see that, right?
Right. Right. Okay. All right. Well, obviously, we'll be keeping our eyes on this. And there are a couple other questions I have for you about kind of the impact of instability, because we're starting to see it uptick in a number of places around the world. But before we get there, why don't you pull up the S&P chart for a second here? Because Lance, you have been saying for the past several weeks, look, market's short-term overbought. There's still an upside bias to this market, but highly likely to have some sort of pullback given how overbought things were in the short term. And while this may have been an exogenous trigger that folks weren't expecting, could this be the pullback right here?
Yeah, very, very much so. And again, when markets are in a very strong momentum-driven uptrend and they get overbought, remember markets move. It's just a function of buyers and sellers. And so there's an old saying that sellers live higher, buyers live lower. And so when markets have these very strong runs, like we've had really since April the 9th, sellers are being drug into the market because let's say I'm long stock and I've got my equity portfolio, I'm fully allocated to equities. Well, if the price is moving up and somebody came to me, and let's just say it's just you and me, the whole market is just you and me. And you came to me and said, Lance, I want to buy your shares of Microsoft. And I'm like, okay, I'll sell them to you, but you have to pay me X, right? You have to pay me a higher price. And so sellers are reluctant to sell in a market that's moving higher. So that's why sellers live higher. In other words, they're always looking for a higher price to sell into. Now they'll eventually sell wherever they think the right price is, and buyers will buy it. But the higher the prices go, the less buyers you have at that level. So the reasons that buyers live lower is when markets do correct for whatever reason, there's a price that they're willing to buy at that is lower in price. So sellers start to try to find where that is. So you see more sellers come to market. And that's why markets move up and down over time. If there's an old saying, there's a buyer for every seller. If that was true and every buyer and seller just transacted immediately at the same price, markets would be flat, right? So it's always a function of the number of buyers and the number of sellers and where that price is willing to be transacted in the markets. So when you get very overbought, very extended, sellers are okay trying to drag out higher prices from buyers. But when an event occurs, all of a sudden, all the sellers will show up at once. And that's kind of what you're seeing a little bit today, is that all of a sudden you've got a lot of people willing to sell today because of the unknown of this. And buyers are going, okay, I'll buy it from you, but I'm going to buy it, 1% lower today or whatever it is. So, this is why technical analysis is important to understand, because it helps you understand price dynamics in the market and what drives markets to go higher or low over time. And so what you've got going on in the markets today is that we're overbought. We've been on a very minor sell signal here. And we just broke. If you notice, there was this really kind of very nice rising trend line to the market. This is kind of this triangle pattern that's laid out here is kind of called like a wedge. And so prices were getting compressed within this wedge. And so technically, if you break out of that wedge in one direction or the other, you typically get a constrained move in that direction. So the fact we broke to the bottom today, if the market closes lower, and in other words, we don't rally through the day and we get back into positive territory, get back into that range. If we close lower here, very likely we may see over the next week or so this market try to work its way back down towards 5,900-ish, maybe 5,850, which would give you a really good entry point to add your equity exposure, because that should work off a good chunk of this short-term overbought condition. And that's what we've been kind of looking for. We've been holding a little bit of extra cash in our portfolios. We've just been very patiently waiting for this market to give us an opportunity to add some cash to the market. But again, we just weren't willing to pay prices, where they were. And this is an important point. I wrote this in last weekend's newsletter because I get this question a lot. It's like, well, you're missing out on the rally. It's like, no, I've got plenty of exposure. Our portfolio is keeping up with the market. I don't have to worry about it right now. And I can have this extra cash as a hedge. I'm not interested in buying lower prices. That's not my job. I don't mind paying a higher price for a stock. Just let's use a simple example. Back in February 19th, the market was trading at all-time highs. We were extremely overbought, extremely extended. So I don't mind at some point in the future if I even pay a higher price for the S&P 500, as long as the risk reward is better for me. Right. Because if the risk reward is at a level where I have more downside risk than I have upside, which is the case right now, then that's not a good opportunity to enter cash. This market could go sideways for a month or two, work off all these overbought conditions, be exactly the same price, or even potentially maybe just slightly higher than it is right now. But after 2 months of consolidation, all these overbought conditions, the imbalance of buyers and sellers has now been rectified. And I may pay the same price or slightly higher, but now the risk reward is in my favor, and the upside potential outweighs the downside risk. That's what I'm looking for to invest capital.
Yeah, that makes great sense. The analogy that's coming to my head, which is probably not a great one, is you could buy a beautiful house on a sea cliff at a certain price, but if it's kind of teetering on the edge of the cliff, you'd probably much rather pay a higher price for the same house if somebody has put a lot of support struts underneath it, right?
Exactly, or maybe just in a different location.
Yeah, yeah, they moved it back about 20 feet or so.
Yeah, exactly.
Okay, so thanks for that. This could be that pause that refreshes, maybe for a reason you didn't expect. And obviously we'll see where things close today, and we'll see what happens next week. And presumably you've got your shopping list. If I remember correctly, you shared a bunch of names with us the past 2 weeks, and so you're just, I guess, just still watching that list and waiting to see if the risk reward ratio gets more into your target zone there. All right, so let's take a second and just talk about this instability. I don't want to oversell this, but we've seen obviously this flare-up that's going on in real time right here between Israel and Iran. We've seen, sadly, a resurgence of kinetic, activity between Russia and Ukraine, right? We looked for a little while there that a ceasefire might be realistic, might be in process, but that doesn't seem to be super close these days. We've had the LA riots. People are debating whether that's the right term to use or not, but we've seen, definitely some issues down in LA. There's some concern that that's going to spread to other cities in America. We just had somewhat of a similar outbreak in Ireland 48 hours ago, slightly different reasons. But there's a theme behind a lot of this stuff that I don't think is going to make these just sort of one-off isolated events. Who knows what's going to happen from here? But it just seems to, from those watching the news cycle here, that we're having more and more agitation, unrest, et cetera here. Again, is this just one of those things that, like, from an investing standpoint, it's noise, don't get distracted by it, just keep your eye on the hard data? Or do you see anything here that just makes you think the world's kind of feeling like it's becoming a less safe place, and maybe there's some sort of, you know, unrest premium that we want to start putting onto equity markets?
Well, the answer is sort of yes and no. So remember, in the short term, unexpected exogenous events, that's what causes markets to move one direction or the other. Hey, I wasn't, my whole thesis was, companies were going to generate X, and now this has occurred, so I have to reevaluate what companies are going to earn. That's the big thing. Is it all comes back down to earnings. So just let's knock a couple of things out real quick, right? So we've had lots of protests before. Remember the whole Black Lives Matter protests we had around the different cities around the country, and they
Right.
were
And that's what people are worried that might happen again. Who knows? Hopefully it doesn't.
right, right. It's terrible, right? And we don't want that to happen. But did it impact corporate earnings, right? Terrible headline events, terrible social events, but did it impact the earnings for Apple or Microsoft or Google in any significant way?
Right.
And really, it's Bastiat's broken window theory. You had to invest capital to rebuild all that stuff, which created jobs. But there's the whole broken window fallacy to that because all you're doing is
Right.
rebuilding stuff you just tore
Right.
down. So that's not
And to your point, it didn't hurt the big, multinational big brands you're talking about. There were a lot of
sure.
local merchants whose windows got broken and boarded up and whatnot, who it was sort of a nuclear event for. But yes.
Exactly. But again, when again, two different things, right? So,
Right.
devastate.
One affects the stock market, one doesn't. Yeah.
Exactly. So what are we talking about here? Are we talking about economically, just, what does this mean for society? It's not a good thing. What does it mean if we're talking about investing? What does it mean for the stock market? Then all we have to know is do the riots in LA or Austin or wherever else they pop up now, are those going to impact corporate earnings? The answer to those are probably no. Now, Ukraine, Israel, Iran, could that impact corporate earnings? There's a higher potential probability that that could be more impactful to markets over time. So those are things certainly you don't want to take off your risk. You have your pros and cons of your investing strategy. Those are certainly on that list on the right hand side, because those have potential events. Now, pros and cons, mind you, like for instance today, Lockheed Martin, Raytheon, defense companies are doing very, very well on this initial attack because that's potentially more business
More
for
business for them. Yeah.
yeah. So there's always winners, and so in any event, also too, it's important to separate out. Okay, this is going to impact earnings. It may impact the broad market, right? And so we may start adjusting value. And again, this is all it comes down to is what happened to forward earnings, and do I need to adjust current valuations that I'm willing to pay for the expectations of earnings I'm going to receive in the future? So that's what the markets are doing at the headline. However, underneath that surface, it's also important to be able to separate out, okay, who could benefit from this and who's going to be the loser? And then separate those two out in your portfolio. So again, looking at the broad market's fine. The market can have a significant correction, and there can be sectors in the markets that do exceptionally well during that process. So it's
I
important to
guess,
separate these things out.
yeah, and I guess on that part, back to oil, are you guys looking at the oil space, energy space any more closely today after last night's events and just saying, hey, if oil prices do go up from here, that might actually, help some of these producers, like you said, who were kind of not profitable recently?
Yeah, yeah, yeah. No, so for instance, like we own a company called 10K on the natural gas side, and we're actually writing. Mike's working right now on a two-part article on data centers and the use of natural gas pipelines because in order to nuclear is very interesting, and this is and nuclear's been on a huge run lately. So companies like Oklo and CCJ, they've been just
They've been
spiking.
great,
Yeah,
right? But that's going to take forever.
yeah, yeah. It's 10 years out, and these companies generate no capital. But what AI data centers are doing is they're building what's called behind the meter, and they're building right on the pipelines, and they can bypass the electricity grid to get access to power generation for data centers. And there's some companies that benefit directly in that space. Kinder Morgan Energy, Williams Pipelines, 10K is another example. And so those companies are doing will do better with higher natural gas and higher oil prices, obviously. And then companies that are actually producing. So, for instance, we own ExxonMobil in our dividend equity model. that's going to benefit from this. What if oil price, if this turns into more than a 1 day event or maybe a 1 week event and things are looking like they're escalating a bit, then we'll want to increase oil and gas exposure in the portfolio also. So yeah, it's I'd be careful jumping on it today because we've seen these events before, and like you get a big spike in oil and then it goes away the next day. So, what we need to see is if this is going to become a more escalatory problem. And if it is, then yeah, increasing oil and gas exposure makes some sense.
Okay. And obviously we'll be tracking this closely, so folks will update you on this next week. All right. So on the flip side, let's try to look at some optimistic developments. So U.S. is back meeting with China. Um, let's say a U.S. I mean, we already sort of had a quote unquote, deal announced with China, which was sort of, and a lot of people are scratching their heads, or they're sort of like, it kind of just seemed like what we sort of already had in place. Yeah, you're raising your hand.
Me too.
Um,
I was like, that's a deal.
yeah, but let's say that's progress towards something more like what the administration has said to expect, where hey, we really get more of what we wanted from China, and the tariffs come down to something super manageable and all that stuff. Um, how much of a how much of a positive lift could that have on the market here?
Well, look, anything that you do, okay, so this whole rally we've had, right? We had a very sharp decline going into April on this concern about tariffs, and then we've had a complete reprieve of that based on the assumption that tariffs are on a pause. So, if we start, and again, the thing we haven't seen, and again, we had this deal done with China, which is a 50% tariff. That's not 10%, right? That's not 20%. That's
Right,
50%. That's not a cheap tariff on China. Now it's on certain things, but still, it's there.
right. Although the Trump strategy super cheap relative to 145%. Yeah.
Absolutely. But it's not cheap on the consumer. Um, and we really haven't seen deals with other countries to any great degree. And now Scott Bessent's come out and he's hinting at maybe extending the. You remember these tariffs are just paused for 90 days. We're rapidly coming up to the end of that 90 days. So Scott Bessent came out last week and he's hinting at extending that pause so they have time to negotiate with all these other countries. But we're what now, 8 weeks into this whole tariff thing, and we've got a deal done with one country so far, and you got 134 to go. So, this may take a whole lot longer, but from the market's perspective, two things are very important here. If you took a look at the CPI, PPI numbers this week, they both came in much weaker than expected. So the tariff impact has not shown up yet in the headline data. However, what we're seeing and what we measure is we look at the differential between what producers are paying and what consumers are paying. And we create a spread between those two reports. And what that tells us is who's eating the tariff. And what we're seeing right now is a lot of companies are having to eat that tariff. That's going to impact profit margins. So the thing we're watching very closely and we need to pay attention to is earnings revisions, which if you look outside the Mag 7, earnings revisions have been going up over the course of the last really 2, 3 weeks. It's all in the Mag 7. Outside of the Mag 7, earnings revisions are basically flat to negative for the other 493 stocks in the economy. So if they have to eat more and more of those tariffs, that's going to impact those earnings. And again, the things we're looking for going forward in terms of investing is what is expected earnings growth going to be and what valuation multiple I'm willing to pay for that. And so that's one of the key risks here is if tariffs don't get resolved, and we don't wind up somewhere around a reasonable expectation. Right now, the average tariff is assumed to be about 12%. So, and markets are okay with this. Markets are doing fine on the assumption we've got about a 12% average tariff. But if this comes in to be 20 or 18 or 25, something higher, then that could potentially weigh on markets and potentially that whole valuation multiple going into 2026, which I think is a reasonable risk.
Okay, so uh, that all makes sense. Just assume for a moment here that everything goes about as good as it could go. I
Mhm.
just wanted to try to see how optimistic things could go. Um, is the market just pricing in, pauses, or is it actually pricing in everything is going to be hunky dory, and if anything less than hunky dory weighs on the market?
I think it's a little bit of the latter. I think markets are pricing in that tariffs are going to be completed. It's all going to be fine. And we're going to wind up in this kind of Goldilocks place. And that seems how the markets are kind of reacting right now. I don't think that's potentially the ultimate outcome of this. So I do think there's risk, and not just from tariffs. The economic data is slowing down, and it's slowing down pretty markedly. We're seeing it show up in services. So if you take a look at the U.S. economy, we pay a lot of attention to manufacturing surveys. The Dallas Fed, the Richmond Fed, the Philly Fed. That's only about 20% of the economy.
Right.
You take a look at services, ISM services index, that's actually in a very slight contraction right now. Now, that's not terrible, but what it tells you is that the economy is slowing down. We're not growing at the rate to support earnings growth expectations where they are. And as we've talked about before, earnings expectations are still very, very elevated going into 2026. So again, I think the big risk to markets is just a realization that this was our whole report we put out last Friday called, and we touched on it here on the show, talking about how personal consumption expenditures, if you really want to know kind of where earnings are going, pay attention to PCE because there's a very high correlation between PCE and earnings, which makes sense because that's where revenues come from. And if PCE slows down, which is, again, back to the employment data, 139,000 jobs at the last report. You need 200,000 jobs a month just to absorb population growth. So we did 139,000. That number is going to get revised lower. The past three reports or four reports have all been revised down like 200,000 jobs in total.
Right.
So if that 139,000 comes in at 100, right, that's certainly more concerning, about the rate of economic growth because we need full-time jobs to support economic activity, and full-time jobs are under a lot of pressure right now. So, again, I think there's a reasonable expectation that continues, and we wrote this early in the year. Expect a year of low returns and a lot of volatility. I don't think we're out of the woods yet, and I think potentially over the next, as we get into August, September, October, I think there's a decent risk of another 5 to 10% correction in here somewhere as we try to start, realigning valuations with economic outlooks.
Okay. I was invited to be interviewed on a X space the other day and, was asked to kind of just put a point of view out there to kick it off.
Mhm.
And my point of view, which it sounds like you may share, Lance, was, and of course, this was before the whole Iran-Israel thing, was that optimism really seemed to be returning to Wall Street, and there was a growing sense, a growing narrative of, hey, we made it through the hard times,
Right.
right? Things look grim there in March and April, but we've come back strong. And the surprises from here are likely to be to the upside as these trade deals get struck, as maybe peace deals get struck, et cetera, et cetera. Um, and, it wasn't a bear market rally. We're still in a bull trend, higher prices ahead. And I was basically saying, I think there's a danger of having too much hubris here, that the volatility that entered this year has been slain, and that
Right.
volatility is probably still going to define the second half of the year as well, for a lot of the reasons that you just mentioned, plus a few others that recent guests in this program have said. You're nodding sort of as I'm saying all this, but it sounds like you feel similar.
Yeah, I do. And again, that's been our whole thesis this year is that, this year could end flat to, slightly positive. Maybe we're up 3, 4, 5, 6% by the end of the year. But you have a lot of bumps along the way. And that's what I'm saying is like, we had this near 20% correction. Now, there's a couple of things to understand is that historically speaking, when you have a near 20% correction, so 20% corrections only happen about 20% of the time historically throughout history. They don't happen very often. So when you have a near 20% decline, those are very important points in markets, but it doesn't necessarily. And so when you see a lot of analysis out says, 20% decline over the next 12 months, markets are always higher. And that's a true statement. That doesn't mean though that along the way you can't have another couple of bumps to get to that higher level. And
Right.
so and again, so I think that, and again, the problem for investors is weathering those bumps. We saw back in April, it's very interesting. Our portfolio on April the 9th, our portfolio was down like 1.5% for the year. and the markets were down, near 20 at that. Well, actually down about 16 for the year at that point. And it was interesting because we had clients calling up. It's like, oh my gosh, I'm just losing all this money and I just can't take the losses. And they were looking at they didn't even look at their portfolio. They were just simply looking at the market. The market's down
Right.
20 and it looked terrible. And so they were panicking. And now, very interestingly, is like, when are we buying more? Right?
Hmm.
Can we get back in? We got to buy a lot. I'm holding all this cash. It's just, I'm like, just patience, man. It's gonna be okay. But this is psychology, and what could very well happen again. I think in September, October, you have another 5% correction, six, seven, eight. Very likely something will happen, and we have another bout of volatility. Then we rally into the end of the year because of stock buybacks, year-end rebalancing, all the things that happen at the end of the year, and we wind up about where we are, maybe a smidge higher. And so we look back and say, see, right, 20% corrections, the year always ends higher. That's true, but did you survive all those bumps along the way? And that's the part that gets most investors, is they get swept up into these corrections and make emotionally bad decisions.
Yep. Yep. So obviously, folks, keep watching us week after week, and Lance will hopefully try to keep you nice and moderated in your emotions. Um, so just to some of the things you mentioned, I just want to dig into, because I had them on the list here. We got the latest CPI data recently. We got the latest PPI data, I think just yesterday or the day before. Um, and they both ticked up slightly, but just barely, right?
Yeah.
And so back in April, the fears were, oh my gosh, all these tariffs, this Liberation Day chart with all these massive numbers is just going to, totally reinflame inflation, right? And TBD, we don't know exactly what's going to happen yet, but we have not seen that inflation manifest in the hard data
Right.
yet, right? And we now have a few months from when these tariffs started getting impacted to look back and say, okay, it's not really making that big of a dent yet. And to your point, the data does show that the producers, the corporations, are eating the cost of the tariff so far. And I've mentioned that they have the ability to do that because profit margins are near all-time
Right.
records, right?
Yeah.
So, we could argue maybe that's the right thing to do, for the country anyways, or whatever. Not that I think these corporations are going to be motivated by altruism, but if to your point, Lance, they're seeing the weakness in the consumer and just saying, look, I'm not sure I can really push this on the consumer here. They've got some slack there to eat some of this. Now, how
Yeah.
much slack do they have? What's their tolerance? We don't know, right?
Yeah. You do.
But you and your partner, Mike Leibowitz, have said for a long time, hey, our main thesis, and this is, why, I mean, you have to hold bonds in your portfolio because you run a 60/40, but why you've been, positive on bonds is, we think, for a bunch of reasons, most notably slowing economic growth, that inflation is going to eventually moderate in the way that the Fed hopes. When you looked at, you've done a lot of comparisons to the Trump 1 administration, and we didn't really see much inflationary impact from the tariffs then. So my point is, we don't seem to be seeing that now. And those that have been really investing or expecting the inflation narrative, I think this is an important time just to check your assumptions, right? We don't know what's going to happen going forward, but we're not seeing a ton of pressures there. And to your point, if the corporations eat the tariffs, that's going to bring down corporate profits. That's probably going to weigh on the labor market at some point in time. But those are disinflationary pressures. If we look at the employment market, we're seeing here that we just got the latest continuing claims data. And while we're not at alarm bell levels yet, you can see the trajectory here is actually gaining momentum to the upside, and we're at the highest level that we've been in 4 years, right? And as you and I have talked about in the past, when we tend to have problems in the labor market, it tends to be after the labor market has bottomed. And once you have that change in trajectory, it
Yep.
really starts to pick up speed. Will that
Yep.
happen from here? We don't know, but this is definitely something that's worth watching. So you kind of put all these dots together and say, hey, we're not seeing surging consumer demand that's providing upwards inflationary pressure. We're seeing corporations eat it so far. That's going to compress corporate profits, and we're seeing a weakening labor market that might get exacerbated by further weakening of corporate profits. You really start worrying more about disinflation than you do inflation. And I don't want to put the word recession out there, But, there's definitely things that we can talk about that we already have, like worsening consumer confidence and a bunch of other stuff that at least make you say, hey, it's a non-zero chance going forward. So this hubris of like, oh no, we totally dodged the bullet and it's glory days ahead. That does feel like it's really premature to declare that kind of mission accomplished message right now in this market.
I absolutely agree. And we wrote an article maybe 3, 4, 5 months ago called "The Risk of Recession Isn't Zero." On that same whole premise. I mean, if you just take a look at the data is clearly slowing down. But what the mistake that a lot of economists are making is they're going, so for instance, first quarter, we saw that negative GDP print. Everybody came out, was like, see, a recession's here. And we were like, no, it's not. This is a function of the trade that's going on, trying to get ahead of tariffs. And this is a trade issue. And that's been resolved. So like second quarter now, that's been completely reversed because you don't have this inventory pull. And so you're seeing the trade imbalance reverse sharply, which now we're going to get like a 2.5% GDP print in the second quarter. So, but
Yeah, I
that's
was just going to ask you about that. Let me just interject just to show it up here. So Atlanta Fed GDP now is at 3.8%. So this is something that's kind of counter to all the points I just made.
but no, but that's just, but when you dig into that, so again, remember, you and I had this conversation about, because we were here and you said, look, the Atlanta Fed's projecting a 2.5% decline in GDP in the first quarter. And I'm like, hold on a minute, that's all because of gold imports. And then shortly after that, they came out and revised it to show it without the gold imports, and it was
Right.
down 0.5% or whatever.
Yeah, it was still down, but to your point, it was down because of the front running. So what we did is we sort of shook the bathtub, right? Everything went way
Yeah.
negative. Now it's way
That's fine.
positive. It's gonna, yeah.
Right. So the next GDP is probably going to be weaker than the second quarter because now all this other stuff's going to start to filter back into it. And that's the
Yeah.
point of this is, you got to be real careful with this. Look, the data is clearly slowing, but we were coming off 12% nominal GDP growth back in 2020. So it takes to get to negative GDP growth, to have a recession, you've got to reverse all of that. And there was so much money in the system, so much capital in the system everywhere. It's just taking a long time to grind this economy lower to where you can start talking about the risk of recession is really getting elevated. We're seeing the early evidence of that, right? But again, we probably won't get a recession this year. But if I was going to try to put some, and I don't like doing this, but if I was going to say, look, based on the current trend of economic data, if everything continues the way it's going right now, probably in 2026, you can actually start talking about a recession because it's going to take that much more time for employment to go from 130,000 to 100 to 75 to 50 to 25, and to start getting negative prints on employment data or whatever it is. It's just going to take more time. And time's always the factor here. So, I think the bigger risk to investors is to pay attention to what's happening with earnings because earnings are going to get reflected by the economic growth. And those estimates are still way too high. They have to come down. The long-term middle average is about $50 lower than where Wall Street currently expects earnings to be next year. So there's big revisions potentially to the downside. That brings the valuation issue into concern. And now you're paying, 24, 25 times forward earnings. Those are going to come down to 16, 17, 18 times forward earnings. That's going to be a decent correction in the market sometime in the future. Again, that's not 50%. I'm not talking about a crash. I'm just talking about a market that has to revalue forward earnings. And that could be a 15 to a 20% decline, next year could do that trick.
So, do you see this as more likely to be the steady march of, your millennial season, everybody gets a medal that just that they'll slowly start marching it down over time. So by the time the actual earnings happen, they're just stepping over a low bar. Or do you fear this is more like a bubble in search of a pin, that it's going to need some event to make Wall Street say, whoa, wait a second, we were being too optimistic here?
It's a second. If everything remains status quo, then every quarter, that we just keep ratcheting down the earnings until we can have a beat rate of 70%, right? So,
Yeah.
and again, this is the important thing to understand about everything in the markets. It's always about the rate of change. Interest rates at 4.5%. That's going to cause a massive economic contraction. No, it's not. The reason is that the longer that interest rates hang out here at 4.5%, the economy normalizes to 4.5% economic growth. And so, or 4.5% interest rates in the economy. 4.5%
Mhm.
interest rates, we were at 5% in 2007. So we're just basically back. Well, we got used to abnormally low rates. We should have never been doing mortgages at 2.5%. That was stupid. A mortgage at 4.5, 5, 6%, that's a reasonable mortgage. But we just got really used to these low mortgage rates. And so now the economy is starting to normalize. The longer that interest rates just kind of stay where they are, the economy will normalize to that. The risk is that if you go from say 3% to 5% in rates overnight, that rate of change is so dramatic. That's what impacts markets. It's the same thing with the economic data. If anything occurs, so as long as with earnings that the economy is doing fine, it's just slowing down, we'll slowly bring down these earnings, it's all fine. The markets will adapt to that. But if something occurs, some event occurs, then all of a sudden the market has to step back the next morning and go, that event, whatever it is, there's no way we're going to generate $260 a share in earnings next year. It's going to be like 180 because of whatever that event is. Then the markets are going to have to rapidly reprice valuations based on that event, right?
Yeah.
And that, so it's always the rate of change in the data. If data is moving slowly, that's not your risk. It's the overnight rate, it's that overnight event, that exogenous event that causes a sudden repricing of markets. That's the thing you've got to worry about.
Okay. All makes sense. And I think you've done a good job of sort of delivering that warning in the past. Let me ask you this. What about something that's sort of in the middle? And specifically, this is top of mind for me because I just interviewed Melody Wright
Yep.
and just released a video with her yesterday on kind of her latest outlook on the housing market, and she's quite concerned. A lot of these trends that Melody's been talking about are increasingly beginning to manifest. So you talked about interest rates, and let's say specifically mortgages, right?
Mhm.
The economy will normalize, you said, as the longer we hang out here at say 4.5%. But there is sort of a higher for longer lag effect, right? Where you have people who you know, they own their home, but all the other aspects of home ownership have gone up. And so, they had a home they could afford. Now they can't so much in getting increased distressed sellers. You also have sellers that were holding on, right? The mantra in the industry apparently was survive to 25 because everybody thought that mortgage rates were going to be lower here. They're not. So the buyers are not showing up. And we now have actually a lot more sellers in the market for the first time in a decade than we had buyers, or aspiring sellers than we had buyers. So, there is the potential that this weight of higher for longer mortgage rates can really start pulling down the real estate market, real estate prices, and then all of a sudden, you get a lot of issues with that, right? Where, people are losing their equity, just everything you get from kind of a big major real estate correction, negative wealth
But
effect, all that stuff.
right, but isn't that what everybody's been rooting for, right? Everybody wants to buy a house cheaper. Everybody's complaining about high.
An aspiring buyer, but if it ends up triggering, potentially a recession, who knows, right? Maybe not,
Well,
right?
yeah,
Great
but
if you keep your income.
yeah, yeah. But no, this is the very interesting about the housing market. And I've said this for a while, is that, everybody was talking about when the interest rates went up and we were at 7, 8% mortgage, like, oh, this is going to cause a housing crash. And it didn't happen. And the reason is because, well, if I'm sitting in my house and I've got a 3.5% mortgage, I'm not going to sell my house to go buy a 7% mortgage. That just doesn't make any sense. I'll just stay where I am. And
If you
I've
could
always
survive to 25, but yes.
yeah, yeah. And as long as you can keep paying your bills, right? Um, but that's kind of the interesting thing is that, I said I've always been of this mindset that you already have this. I think there's a lot of pin-up sellers out there, and more than even you think, right? So if you look at the data, we have 500,000 more sellers than we have buyers right now. Um, but if rates ever came down, so if the Fed, and again, I don't think the Fed wants to get back to 2% interest rates on 10-year treasuries. That's not healthy for the economy. That's not healthy for businesses. 0.5% on a 10-year treasury is not a good rate. They should be around economic growth and inflation, and that should be somewhere around 2.5 to 3%. And then, yeah, that's the chart.
Yeah.
So the one thing is that I've always said is that if for some reason we get a pop down in rates to where mortgages are really cheaper, maybe you get back to a 4.5% mortgage, 5%, something like that. All of a sudden you get this massive rush to sellers to market because now you've actually got buyers willing to buy it. And but you're not going to be able to play catch up with the number of buyers that can qualify to buy a house versus the number of sellers hitting the market. And I think that's the risk where you may actually, which wouldn't make sense, right? Because now I've got a low mortgage rate, so I can afford to buy a house. But the one thing we've never talked about is the potential, kind of avalanche of supply that would occur in that environment that could actually create your housing crash at the time where you think there wouldn't have one. And it's just a theory, but I do talk to a lot.
So interject, but Melody thinks exactly the same, just so you know.
Okay. Well, yeah. And so I think I've talked to a lot of people that would be willing to sell their house if they could get a cheap enough mortgage to go buy something else because they really want to move. They want to go somewhere else, but they just can't afford to, right now. So I just think that might be the interesting phenomenon that shows up.
It could, and that's one of sort of Melody's warnings. So she's like, kind of irrespective of where mortgage rates go, she thinks that more supply is going to come into the market,
Yep.
right? And right now we have a market where, um, uh, inventory is continuing to increase. The mortgage rate, like we just said, no matter where it goes, it actually creates problems. And so the only real mathematical outcome to that is that prices have to come down.
It's interesting. I got into a debate with a young gentleman. He was 35 years old. He's complaining about not being able to afford a house. And I said, "You can afford a house." And his income was $60,000. I said, "You can afford to buy a house." And so I walked him through the math of how he can afford to buy a house, what he has to do to get there, and those type of things. But I ran an interesting search in Harris County, I live in Harris County, which is Houston. And talking about the real estate market, I just ran a quick search. I said, find me every house in the city of Houston that's less than $200,000. There was 191 houses. Almost all of them were in foreclosure, bankruptcy, or some
Mhm.
form of that. And I think that's more indicative of what's happening underneath the surface because you wouldn't expect to see that many houses potentially, in foreclosure, bankruptcy, some type of, tax lien default, whatever it was. I was kind of surprised by the number that came up. And I think that's also kind of indicative of where we're getting to in the economy. The economy is slowing down. People, you don't hear, those type of houses, they don't hit the headlines. You hear about the $1 million house or the $5 million house or the $20 million mansion that went into foreclosure, right? That's what makes the news headlines.
Right.
But I think this underlying economic deterioration that we were talking about earlier is impacting the lower income strata of the economy, and that's
Economy.
going to start to feed its way up eventually.
Let's actually put a pin in that because there's a really interesting point I want to make that's really tied to that exact point.
Okay.
I think you're going to get even more surprised by that volume of inventory going forward from here, Lance.
I wouldn't doubt it.
Um, and by the way, Melody was saying that you actually can, like if you're an aspiring buyer right now, and obviously it depends on what market you're looking at, because not every market's,
Yeah.
real estate's very local, as we all know. Um, but but increasingly you can actually now begin to find really pretty good values. But you got to hunt, and a lot of these values aren't appearing in the local MLS listings. And one resource you mentioned here from my notes, a website or an app called Property Radar. So,
Yeah.
anyways, if folks are interested in looking for that type of stuff, you can go check out Property Radar and see what they find there. But if you're willing to do the work, right, like look through the foreclosures, go to the auctions and all that stuff, you increasingly can find, decent deals and sometimes in pretty attractive areas. Now, that being said, Melody said, look, if time's on your side, wait. Like she thinks that it's going to get, a lot better for buyers over the next coming years. This isn't like, an immediate term opportunity. The wind is going to finally be in your favor here. So anyways, we'll see what's going to happen from there. Um, all right. Why don't I get to that pin and then we'll keep on going here. So I talked to two people this week, Lance, had two really interesting conversations. These were older people who uh, had worked for much of their careers with some of the greatest living investors. In one case, it's Paul Tudor Jones. In one case, it was Peter Lynch. And I want to share this with the audience here, that we do our best to create what I like to call a financially nutritious serving here of content. And we have a great audience. Its composition always blows my mind when I look at the data that when I run surveys or when platforms like YouTube, share the overall stats with us. And obviously, when I interact directly with people, I'm always just amazed at the quality of the individual that watches this channel. But I keep having interactions like these two I just mentioned that surprise me in terms of just the level of accomplishment of a lot of the people that watch this channel. I mean, we reach a quality of viewer that I'm incredibly proud and impressed and really pleasantly surprised that two guys here who like to just kind of shoot the breeze, weekly. The fact that people of this caliber are willing to, watch this channel, invest their time, and apparently like the content and care enough to, engage and give feedback about it. Um, yeah, I wish I could share specific names. I can't, but I mean, uh, you probably have the same thing, Lance, with the media that you appear on, but it's a real honor that people of this pedigree are part of our community. And I just want to make sure that everybody who's watching kind of gets to, this is something we've all created together. So I want to make sure everybody gets to hear that.
No, I agree. It's, when like I publish articles or whatever, and I'll get emails from people, I'm like, really?
Yeah.
You read it?
And you're listening to me? Yeah.
Yeah. I'm like, I listen to you.
Yeah,
And
exactly. Exactly. Well, in one of these
it's
guys,
very
I,
interesting.
I hopefully will be able to share the name soon. I've invited them to come on the channel because they actually have uh, again, a really impressive pedigree. But they were highly engaged on this, connecting some of the dots from several of the interviews that have happened on this channel. So again, I was shocked that not only did they knew the channel existed, but they've watched enough to say, "Oh, well, you said this, and this guest said this, and I'm going to help you connect the dots with the pieces of the puzzle that I have." And his whole point, if he comes on the channel, I'll let him explain kind of his whole macro worldview, but is that we're starting to see an ebbing of you could call it liquidity, you could call it savings, globally capital, and and we're not yet seeing it manifest in a lot of the major indices that we all look at because it hasn't hit there in force yet. And like any weakness, it breaks in the weakest points first. And so to your point, Lance, we're seeing the weakest of the areas of the consumer space start to buckle. Like that's where the pressure is currently being applied and starting to do real damage. And then it'll just work its way up the chain from here. So, all the consumer data stuff that Stephanie Pomboy mentions, obviously the Joanne Shu, the director of the surveys at University of Michigan, who was on a week ago, who was talking about the deterioration of folks' sentiment there. And a lot of this was triggered by you were talking about how, well, how come, when mortgage rates spiked up to 7%, we didn't see, a massive correction in the housing market? Well, part of the reason for that was we still had the pig going through the python, and people still had forbearance on a number of parts of the debts they owed. That's all gone. The last one that's gone back into repayment is student loans, right? And that's the one you can't discharge in bankruptcy, so you got to pay that one. And that's beginning to steal from other debt payments, which is why we're seeing the delinquency rates go up and then eventually the default rates go up. So this is sort of like, collapse happens from the outside in. The weaker players start buckling first. He's got a really interesting take on that, but it underscores or validates the point that you were making there, Lance.
No, that's right. It's interesting. I had said, about consumer confidence. The University of Michigan came out today. And I said, don't be surprised to see a big jump in the confidence index
Yep.
because we got the tariffs behind us and it came in and went from 52 to 60. So it's a really
Mhm.
big jump. But that'll probably fade. Again, that's just, kind of these near-term effects that are happening. It's like, oh my gosh, tariffs are over. So I'm happy.
Right.
But again, what this is going to come back down to is ultimately, as we move forward, it's going to be, can I make ends meet? And I still think we see a further deterioration in sentiment, as we get further into the year.
Okay. Well, I sadly think you're probably likely going to be proven right there, but folks, we'll track it for you. We'll keep our eye on it. All right, Lance, going to get to your trades in just a second. You put out a video the other day. I just want to see if there's anything you want to let this audience know about it, where you said that hindsight's a terrible way to invest money.
Yeah. We've talked a lot about, we've spent an inordinate amount of time on our daily program recently talking about narratives and psychology, just because there's so much stuff going on in the world right now. So we're getting a lot of questions about, oh my gosh, this person said this narrative, or this person said this about this. And it's important to, kind of set those things aside because those all impact our psychological needs. And so we kind of discussed this whole negativity bias we have. As humans, we love to watch, murder shows or disaster shows, whatever it is. There's an old saying in news, if it bleeds it leads, right?
Exactly. Yeah.
It's just human nature. We're just that way. So the negativity bias, we feed on that. So we like negative news more than we like optimistic news. But we went through kind of this whole analysis about understanding how psychology works. And importantly, and this is one of the interesting conundrums we're at right now. Lots of negative news out today. And look, the market's down, again, like we were saying earlier, the market's down about 80 basis points right now in the news of this whole Iran-Israel thing. That's because the herd right now is in the middle of a move. We went from extremely positive at the beginning of this year. Everybody was exceedingly bullish at the beginning of this year. And by April the 9th, we had some of the lowest levels of negativity, or the highest levels of negativity, I should say. The readings were the lowest that we've seen since the financial crisis. I mean, everybody was just uber negative about the markets. And then, of course, all you need was a little bit of, we'd written the article on April 9th, April the 7th called Hope and the Fear, and said, this is where when you're thinking you want to sell, this is a time to want to buy. Because this is the most negative we're going to get. And of course, that was the bottom and the market's rally. Well, right now we're in the middle. And the herd is always right in the middle of a move. So this market's moving higher. All sentiment gauges are in the middle. They're in that kind of the middle band of the range. We're not overly bullish. We're not overly bearish, right in the middle. So the herd tends to be right in the middle. They're wrong at both ends.
Yeah.
At the extremes. That's one of the reasons right now that, it's important not to be overly concerned about negative headlines, because the herd right now is looking past all that and they're focused on the future. Now, once we start getting back into more bullish extremes, which could happen in the next month or two, then we're going to start worrying about what's that next event that can cause a reversion in that sentiment. But right now, the sentiment levels we haven't sucked enough people back into the markets yet. Professional investors are trying to play chase at this point to try to catch up with the markets. They were heavily selling off and short Mag 7 stocks. Now they're trying to get back into them because retail investors did a really good job of buying the dip. Professionals didn't this time. So that's going to last a little while longer. So there's an upward bias to the markets momentarily. And so that's why we pay so much attention to these technical gauges, the indicators we put in the newsletter, et cetera, because that kind of helps you define when the environment is getting right for a correction. And we're just not there yet.
Okay. All right. All right. Well, look, Lance, trades. What trades have you guys made at RIA, if any, over the past week?
None. We're holding about 20% cash right now and just waiting for an opportunity to deploy that cash. Again, we're not in the right position for that right now. The market's overbought. We're on a sell signal. We need to work off some of that short-term exuberance that we saw from April the 9th, and maybe this correction that started today, maybe this will be it, and this will last a few days and give us a bit of a pullback here. But again, we have our shopping list of stocks that we talked about, and in fact, I have that shopping list in today's blog post. So if you either go to our Substack page at Lance Roberts or on our website, realinvestmentadvice.com, it's talking about how AI can cure our deficit concerns. And I go through this whole analysis of the impact of infrastructure build out, AI, and all that. But in that article is kind of a list of stocks that are on our shopping list right now. And we're just waiting for a better opportunity on a risk reward basis to start adding in those positions to our portfolio.
Okay. And Lance, just as a reminder, we had asked folks if they were interested in us doing a special session on the AI investment opportunity along with energy. And interest was sky high. So it would be good to get you, whoever else from RIA you want to get involved, Michael, whoever. And we do this maybe as like a special event, hour. We let you guys talk for half a bit and then just take Q&A. Does that work for you?
Yeah, yeah. Like I said, Mike's working on a two-part article right now on the power side of it. He's got most of his data in, so we can probably, do that sooner than later.
All right, let's wait for that to come out, but you and I will work over the course of the week to just try to put a stake in the ground for a time at some point in the near future, and then we'll let everybody know about it.
Sounds good. Yeah, don't
All
forget we
right.
have 4th of July coming up. So
So we won't do it on the 4th.
yeah, don't do it on the 4th. Because I'm going to be in London that week. So you're going to have Mike on that week anyway.
Oh, very cool. For fun or for work?
No, going to go see our son.
Okay, good.
So
So
we haven't seen
I'm
him.
sure for fun that you'll be doing more work than you want to from the road.
Actually, what I'm trying to organize right now with my wife is I want to go to the farmer's dog. Are you familiar with the farmer's dog?
No.
Okay. Do you know who Jeremy Clarkson is? Jeremy
Yes, but
Clark, so Jeremy Clarkson is the guy that ran the Grand Tour for a long time, and he had the show on driving sports cars and did high-end sports cars and drove Bugattis and all that. And
okay.
anyway, he did the Grand Tour and he's done a lot of other stuff. Well, then he got into a fist fight with one of the producers and got fired from the show and went and has been running his own farm. And so on Amazon Prime, they're on the 4th season right now, about to come out with the 5th season of Clarkson's Farm. And it is hysterical. If you ever want to watch something for pure entertainment value, go watch Clarkson's Farm. It's absolutely a riot.
Is
But
it like a Green Acres type of thing where this guy has no business
he
running a
has
farm,
he
but he
has
does? And
he has no idea how to farm, and it's all. But there's a better interesting sub story to this whole issue of Clarkson's Farm. It tells you how screwed up the UK economy really is. Because every time he goes to do something, he's got a manager he works with that's telling him you can't do that because of this regulation and that regulation and this tax and this tax and all this stuff. And there's all these impediments of him trying to run this farm, but it's hysterical. But anyway, he's very smart and he's always coming up with new ideas about how to profit off his business. And so he built a farm shop where he sells a lot of his farm products, and he just bought a pub that is called the Farmer's Dog, and he is now basically has created a kind of a co-op of other farmers
yeah.
in the UK to provide all the supplies and necessary for this restaurant and this pub. So we're trying to organize. It's about an hour and a half away from where our son lives. So we're trying to rent a car so we can go eat at the Farmer's Dog.
Oh, very cool. Well, let me know because I'm going to be over in the UK briefly about a month after you, and if it's worth it, I'm trying to get together with Sven Henrik, and it would be fun to meet him at a place
That
like
would
that.
be fun. Yeah, yeah, that would be fun.
If you meet this guy, Jeremy Clarkson,
Yeah, yeah.
if you're able to meet him, be great to see if you could wrangle into him maybe doing an interview with us. Because as you were talking about him, it made me think about Joel Salatin. And for those of you watching who know who Joel is or watch the interviews I've done with Joel, um, Joel he's probably the most famous sustainable farmer in the world, and he calls himself a lunatic farmer because everything that he does is basically against what the conventional regulations are. He actually wrote a book called Everything I Want to Do is Illegal, right? To your point, Lance, and he has all these crazy stories about like, yeah, I just want to like sell this product to the people who live near me. And
Yep.
it's ridiculous, either what he's not allowed to do or the hoops he has to jump through. Like in many cases, yeah, I've got this pig on my farm. I want to butcher it and sell the bacon. Okay, well, I got to get the pig killed by this special person. It has to be sent out of state and processed. I mean, it's ridiculous, right? So, anyways, one of the things that really brought warmth to my heart was when the new administration came in and they announced that we're considering sort of unconventional people for a lot of these different agencies. Uh, they reached out to Joel pretty early on to be an advisor to like the FDA and figuring out how to do a better job there. And I haven't connected with Joel to see what responsibilities, if any, he's taken on. In fact, I'd like to have him on the program again soon. So if we could do a duel with him and Jeremy, that would be really cool.
That would be cool. If I run into him, I will certainly throw it out there.
All right. Well, look, in wrapping up here, and we got to go in just a few minutes, so we'll keep it tight. Uh, I did something, Lance, that you and I have talked about a bit of wanting to do, which is I had one of my nieces. She came up to me right after she graduated high school the other day, and said, "Hey, Uncle Adam, I want you to teach me how to do money." And so I put together kind of, a distillation of everything that I think a young person going off into the world should know about building wealth. Uh, Trying to keep it simple as possible, as non-overwhelming as possible, and yet still try to make it, digestible and engaging and maybe a little bit fun. And I give myself about a B plus, I think, on it. Um, but what was great about the experiences is it really had me break the back on doing what you and I had been saying, which is, hey, we want to put together kind of a primer for people like that. So I'm going to package it together into a video. Folks, it's probably going to take me a couple of weeks, maybe a month, hopefully not much more than that. But anyways, Lance, I'd love for you to be an early reviewer because I know this is close to your heart, and I'm sure you'll find a couple of things that I could be doing better in that. But once it's past, your review, hopefully it might be ready for prime time.
Yeah, no, that'd be great. I'm actually in chapter 5 right now of an ebook I'm writing on the basics of investing as well. So maybe we can tie all these together.
Great. And just to be super transparent for folks, like I made the investing part really easy. Your advice, Lance, about like if you're young, really of the three muscles, earning, saving, and investing, work really hard on the first two.
Yeah.
And the investing part, until you've saved up, till you've maxed out all your retirement accounts, until you've cleared $100,000 at least, just put it in an equity index.
Yeah.
Right. Just focus on getting your money in there. Let compound interest and the market's long-term rise work for you. And just spend your time learning about the market, watch how it reacts to different things, but don't distract yourself by trying to understand all the different types of financial instruments and, buying individual securities and all that stuff. Just work on
Yeah.
making sure you know how to build an income, maybe over time, multiple streams of income, save as much of it as possible, and then let the general market drive for you. And then when you get substantial assets and you've got a bit more maturity, then we talk about the other stuff that you can do, the other bells and whistles.
But that's not nearly as fun as watching the guy on TikTok that says buy some, cryptocurrency that's going to make you $5 million overnight. That's
No, no.
that's the hard part for young investors is they get distracted by all this stuff that's online and these videos and stuff by people that really have no business making videos or instructional advice. And it's great stuff that may work really short term, but it winds up costing them so much money over time because eventually that stuff fails to work.
Exactly. So I think a big part of delivering this message is like right at the start saying like, look, I'm not giving you like the secret stock tip that's going to go up, 1,000% because there isn't one, right? There isn't a secret stock tip that, market insiders have here. And, you're going to get here leveraging your greatest asset, which is time. And, this might sound a little bit boring to you, but it's going to be easy, right? You don't
Yeah.
have to take a bunch of risk. And the thing that actually motivated, I think energized my niece the most was, when I talked about compound interest, I actually pulled up a spreadsheet that I'd created. And she's turning 18 in a couple of days, right? So she's got a lot of years ahead of her. And she just got some scholarship money. And so I said, look, if you just took that money, just a couple $1,000s, and you put it in the market here, and it grew at the average market rate for the rest
Mhm.
of your life, here's what, and you did nothing else. You didn't put any money, you just forgot about it.
Yeah.
Here's what you would have at 30, 40, 50,
Yeah.
60. By the time your grandpa's age, this is how much you've had. And she was like, oh my goodness, right? And I said, look, if we just put a little bit in here, manageable amount a year, just a couple grand a year, right, on average the rest of your life, I can make you a millionaire by the time you're 50. And that
Yeah.
really blew her mind. Just to see how big the numbers got, the
Yeah.
fact that, oh my God, I could really be a millionaire. And the fact that it didn't require really that much money on a relative basis.
Yeah.
It just requires a lot of consistency and dedication and using time to your advantage. Um, I think more
Yeah.
than anything else, that really left her feeling lighter, like, oh my gosh, like a financially robust future is in my grasp. I didn't really think so, but now I really have some confidence in it.
No, it's very interesting because I get a lot of emails from your listeners, and I get the they fill out the thoughtful money form, and they say hey, I'm just starting out. I've got less than $250,000 to invest right now. What do I do? I need an advisor to do this. You don't need an advisor. And here's some steps. So the first step is pay off all your debt. never use credit cards again. And, the only debt you can have is your mortgage, and then fully fund your 401k. And so I give them all the steps to do it. Right. And, and it's always interesting. Either I get no response back because immediately they're like, yeah, that's not what I wanted. I wanted the hot stock tip.
I wanted the secret stock. Yeah.
Yeah. Um, or it's just like, oh, I can't do that, right? They just give up immediately. And it's unfortunate. Now, every once in a while, I'll get a very thoughtful response back saying, hey, I've never thought about that. And here's where I am. What's my next step now? And those people are going to be very successful. And unfortunately, when you see, it's not that long of a list. It's about 4 steps, but you can build an immense amount of wealth. But there's so many fallacies that you've got to work through. This whole idea you've got to have a credit card to have a credit score is completely stupid. That was originated by the banks to get you into the credit card trap.
Yeah,
Pay
and
your
I
bill.
spent a lot of time with my niece on this,
Yeah,
and it could see it took a little while for her. Like, really, like she didn't trust me initially.
yeah,
Yeah.
exactly. But there's so many of these fallacies that you've got to work your way through, and then you know, everybody's wanting to be rich now, right? How do I get rich quick? And money doesn't work that way. You can get rich quick now. And as I've said before, if you treat the market like a casino, it's going to treat you like a casino, and the house always wins. And that's going to happen. You're not going to beat the market at the game. The market will beat you. But if you use the market to grow your wealth and do it correctly, you can build a lot of wealth. You can be very successful. You can buy a house. You can do all these things that you think are impossible right now, but you've got to be willing to do the work. Going back to our conversation earlier, I was talking to the young kid. He's making $60,000 a year, wants to buy a house. It's like everywhere I read, it's unaffordable. And so I sat down and said, look, first thing to do, let's just make sure you've got your credit in place. You've got to save up the down payment. We've got to do that. So let's assume we've got that part done. And then we can start looking for a house. Well, I want to live here. I want this type of house. Or you can't do that. We've got to go look for the house that you can afford in the area you can afford, and we can turn that into an investment property for you to grow into, since this is your first house. Then we'll eventually sell that property, and we'll start to scale ourselves up into the house we eventually want somewhere. And he's like, oh, now I understand. And but nothing is quick. Everything requires steps to get to our end goal. The problem is we want to go from zero to goal and not do the work in between.
So I was giving her kind of quotes from successful investors along the way.
Yeah.
So I gave her this one from Charlie Munger. The first 100,000 is a bitch, but you got to do it. I don't
Yep.
care what you have to do. If it means walking everywhere and not eating anything that wasn't purchased with a coupon, find a way to get your hands on $100,000. After that, you can ease off the gas a little bit. But to your point there, Lance, right? It's like you just got to do what you got to do to hit these goals initially. And yeah, you might have to take public transit. You might even not have to have a car. I mean, this might blow people's minds. I didn't own a car until I was almost 30, 29.
Yeah.
Yeah. I just found, ways to get
Yeah.
around otherwise, other people who would let me mooch off their car, or I used public transit or whatever, right? Because I was doing it the way you have to do it. I was telling my niece that, like, when my wife and I had her cousin, our first child, we lived in, I don't know, like a 300 square foot apartment above somebody's garage, right? I
Yeah.
mean, it wasn't sexy, right? But we made sure that, we were never digging the hole deeper. We were always, building from the start.
Yeah. No, that's just the core principles of building wealth and money. And again, it's just, if you're willing to do the work, it is easy to build wealth. And again, think about it to your point, right? I make $100,000 and I invest that. And I make 10% a year. Just easy. I need easy math. It's early in the morning still.
Yep.
So great. My
10%
100,000.
nominal, but yes.
Yeah, yeah. So, my 100,000 made $10,000, right? It doesn't sound like a lot. But if I can grow that to, 20,000 to $200,000, then I'm making $20,000 a year. When I get to a million, all of a sudden I'm making $200,000, sorry, $100,000 a year on my $1 million that I've got invested. All of a sudden my money is actually making me a year's worth of salary. And that's the key thing that we've got to focus on ultimately is like, when can I get my investments to start replacing my salary? Or at least, being my salary. So I
Right.
can have the opportunity now to do other things. And this is the one big factor that a lot of individuals overlook. They're too busy trying to live for today, I saw an interesting article out. Gen Zs, their future is no house, no retirement. That's the way they view things. So they're just like, I'm just going to spend everything now. I'm not, I can't afford a house, and I'll never be able to retire
Yeah.
because that's everything I hear in the headlines.
I live in the moment, and I'm just never going to leave the moment. Yeah.
Exactly. But that's your choice, right? You have a choice to do something different. You can't afford all these things. Maybe not today, maybe not this minute, maybe not next week, next month, but you can afford to buy a house. You can afford to buy the car that you want, but you're going to have to do the work to get there. And it's going to take time, effort, dedication, sacrifice today. And we just have to be willing to do that work.
So, one of the things that I brought up to show here, and I'm going to pull it up here on the screen, was the cash flow quadrant, which has been made famous by Robert Kiyosaki's Rich Dad Poor Dad, which
Yep.
this was a real helpful eye opener for her, which was, I think most young people, when they think about a career, they think about working for a paycheck because it's all they know, right?
Yep.
So I won't get into this in a lot of depth today here, folks. If you've never seen this before, there's basically four ways that you can make money. You can be somebody's employee, right? Where you literally trade your time for money. You come in, you work, an hour, they pay you for an hour, right? Uh, you have the least control over your destiny there, and taxes are the worst there. Self-employed, that's more like professionals, doctor, lawyer, dentist, that type of thing. You generally make more money because you're more specialized in your services, but you're still trading your time for money, right? If you're a dentist and you don't get up in the morning and don't clean any teeth, you don't get paid, right? Um, you want to try to aspire to get, I mean, stay wherever you're happiest, but in general, you want to try to aspire to get over to the right side of the quadrant here, top right here, the business owner. That's where you can start to scale, right? So that's where you create a business structure that hopefully makes more than $1 for every dollar you invest in it. And over time, you can hire employees who help you scale, right? Who increase your ability to make money. And importantly, if you sleep late one day, you're still making money because your employees are there running the business. And then to your point, Lance, at the bottom there, the investor quadrant, that's where your money starts making money for you, right? You take the excess money that you're making, and you can obviously invest as an employee or as a self-employed person. It gets to be easier to do it if you run a successful business because you can scale more, so your profits can be bigger, and also you've got more favorable tax treatment. But anyways, as I sort of walked her through all that, it was
Real,
helpful.
yeah, real quick, just on
Yeah,
that. Can you bring that chart back up real quick?
yeah, sure.
Because there's one real important facet of what you were just talking about. Out of those four quadrants, the E is the only one where your income is capped. As
Yeah,
as,
well, yes, okay, yeah,
as an employee, I'll only get paid my salary, but in every one of those other quadrants, this is why I'm a self-employed business owner and also invest.
yeah.
My income is not capped in any of those other three quadrants, which is why it's so important. If you can work your way out of being an employee, your ability to build wealth vastly improves because you don't have a limitation to your salary.
And that's a great
Your
point.
income.
And I know
Yeah.
Kiyosaki really underscores that too. I hesitated when capped because you're right. If you get paid 50 grand a year, that's your salary. That's all you're going to get. Someone would say, well, what about overtime? If I work in overtime, great, but you're limited by how many hours there are in a
Hours you
day,
got.
right?
Yeah,
Yeah,
exactly.
exactly. So yeah, so what was really the point I wanted to make here was that all she knew
Was
really
that
was this E quadrant. She didn't realize these other ones existed. And as we kind of went through everybody in the family and mapped them to where they were, it was really eye-opening for her because kind of as we did, she could kind of intuitively know that like, oh yeah, that family member who's more successful than the others, well, they're in the B quadrant or they're in the I quadrant where everybody else is an E or in some cases an S, right? And we weren't trying to ascribe any value to that. Like it's a better person or a worse person, but she could just see like if I really want to earn money, if I want to be more financially successful, I can even see in my own family the people who are in the B's or who are in the I's
Mhm.
are the more financially successful. And so it
Yeah.
just opened up this world that I don't think she really had thought of before. So anyways, hopefully folks find some of this stuff inspiring. And if I can get this thing produced as quickly as I can, Hopefully folks might have, kids or other people in their lives that think might benefit from this. I've certainly gotten a ton of comments through YouTube and emails from folks that have heard me talk about this over the past week saying, hey, when that's ready, send it to me. So I will prioritize trying to get that produced as fast as I can.
Yep. That's great.
All right. Well, look, folks, as we wrap up here, if you think that the fastest way to financial nirvana is to continue listening to Lance Roberts on this channel week in and week out, please let him know that by hitting the like button and then clicking the subscribe button below, as well as that little bell icon right next to it. Folks, do take a second to subscribe to this channel if you haven't already. And even if you're subscribed, make sure you do click that bell icon. I've been looking at the YouTube stats, and it's crazy how many people watch this channel who aren't subscribed. And I always get emails from folks saying, hey, when's your next email coming out? I'm like, if you are subscribed, you'll get alerted when it's out. So make sure you take a second to do that. Also, if you would like some help in navigating your financial wealth through the volatility that the rest of this year may hold for us, highly recommend that most people watching this video get that help from a good professional financial advisor, one who takes into account all the macro issues that Lance and I have talked about here. If you've got a good one who's doing that for you, great, stick with them. But if not, consider scheduling a free consultation with one of the financial advisors that Thoughtful Money endorses, perhaps even Lance himself and his team there at RIA. To do that, just fill out the very short form at thoughtfulmoney.com. Only takes you a few seconds to fill out the form, and the firm will be in touch with you very swiftly after you do that. Lance, my friend, another great week as usual. I'll let you have the last word.
Nope, that's it. Again, as we're talking, the markets are starting to slowly kind of recover from, this morning's initial news over Iran and Israel. So, next week we'll see what happens and we'll take it from there.
All right. And speaking about Iran, Israel, I'm going to hop and do that live stream with Ryan Bowl. So folks, if you're interested in getting, again, the deep dive into what's going on between Iran and Israel, go watch that video after you watch this one. Let's just all collectively hope that, cooler heads prevail and things don't escalate from here. I haven't been watching, Lance, so I don't know if Iran has started a retaliation yet. I'm going to guess not if the markets are marching higher here. So we might still have that shoe to drop, but like I said, hopefully we get through it okay.
Yeah, absolutely. So yeah, we'll see. We'll see what happens.
All right. Well, buddy, thanks so much for another great week. Everybody else, thanks so much for watching.